give us your take on how all of this monetary policy action, not to mention fiscal action as well, is affecting the bond markets.
Hi, thanks for having me on. So I think this entire situation has sort of morphed from being a supply shock to a demand shock to a market functioning issue. I think last week there were days when equities were underperforming and actually treasury yields were rising. So the Fed, I think, came in very strongly. They now have an open-ended QE program. I'll just tell you, by the end of tomorrow, they would have already surpassed what they did in QE2. So, QE2, which lasted 9 months, was about $600 billion. They'll be at $600 billion within 2 weeks. So I think the Fed is telling us very clearly that they want market functioning to come back to normalcy, at least in the Treasury market. You have to start there, and then over time that's going to filter through. So they've been very flexible. They've been very proactive. I think that's actually bringing normalcy somewhat to the Treasury market. Now, Treasury rates are somewhat in a flux because there's going to be a record amount of increase in Treasury supply. We have, we have the stimulus bill of $2 trillion, which not all of it adds to the deficit because about half of that is actually loans, most of which should get paid back. But still, we're talking $1 trillion more net issuance of treasuries. So if you think of the Treasury market, at one point you have a significant amount of supply. On the other side, you have the economy that seems to be slipping into a recession, and the Fed that's buying. Now, my sense is that Fed buying and the economy ultimately will dominate. I think the Fed buying will offset all the additional supply. So, I think in terms of rates, this means rates should stay here, decline a little bit in the near term. But the other part, you ask about the bond market and the corporate bond market. I think there's still stress there because default risk is getting repriced. I think the big question mark, we've not had something like this happen to any of us before, is, how short or how long will the recession be? The longer it drags on, the more that default risk gets repriced. So while I think normalcy is coming back to treasuries, corporate bonds need a little bit more time for people to feel confident that, they will get their money back.
Yeah, I was going to ask about the normalcy in the Treasury markets because this entire week we saw Treasuries really trading at a narrow range when compared to the huge moves that we've seen already this month, right? So could we just say that a lot of the downside risk has already been priced in?
Yes, and I think today we saw this huge spike in initial claims, which actually came in higher than, I thought we were very pessimistic. We were looking for 2.5 million in jobless claims. We get 3.2, and yet, Treasury rates didn't fall. So I think we've priced in the bad news. What now we need to figure out is how long is this going to last? I think the market's pricing in this weakness to last 1 quarter, a couple of months. The longer it lasts, and I think this is where, unfortunately, none of us are experts, and we're all looking at the rate of infections and the mortality rate. It's all of that which is going to drive when can people come back to work. So you've got this dynamic of how long will it last. I think that we don't know, but my sense is the market's pricing in a fairly short, duration of this weakness. And then how effective can the stimulus be? Because we're finally going to get checks given to people. But the thing is, if you're stuck at home, you can't really spend it. So, the multiplier might be actually less than what people are expecting. But the fact that the Treasury rate, I think we're pricing in some weakness, we're pricing in some support from stimulus. It's just a month from now when we realize we're still stuck at home and the data is not looking any better. I think that's when you can get that further downside move in yields.
Priya, it sounds like then you think this is just a reflex rally that we've seen over the past 3 days in global equities.
I think so. I think we went pretty far, very fast. I think the market repriced from this is nothing, this is just a supply chain shock to, this might actually be a recession. And then we've got this immense onslaught of stimulus globally as well as within the U.S. We've had the fiscal, it's a massive package. So we've had a big fiscal package and huge amount of monetary stimulus. So I think, this helps the market sort of find some sort of bottom. But now, unfortunately, we have to look at this infections, and maybe I've been staring at these curves a lot around how the infections are growing, or the fact that I'm in New York City, which seems to be this, place where there's a significant growth in infections. I don't know, those numbers don't give me a lot of, comfort right now. I think as testing picks up, these numbers will only grow. So even if some parts of the country can come back online, I don't think New York, I don't think California, some of these big regions will still be on lockdown. And that's when the market might have a second moment of doubt saying, we've just had all the stimulus and we're still stuck at home. And so the stimulus is not really being able to work through. I think that's when you can get a second leg of sort of nervousness, risk off. But that will need more data. So, as we start getting data for April, May, I think that's when you'll get this, renewed nervousness or risk off.
Priya, does that mean we're not to discount the potential strength of the dollar and the king dollar story going forward? It is setting up for the worst week in about 11 years, but this comes on the back of the best week for the greenback on record.
Right. And I think the dollar, and I sort of go back to the 2008 crisis as well. I mean, there are big differences between 2008 and now. But price action-wise, or the fact that the stimulus-wise, I think it's all happened faster. What took 6 months then is happening all within 2 weeks. But if you go back to 2008 as well, initially the dollar strengthened. And then as you began to see that, all the stimulus coming through, the fact that growth was weak, over time, then the dollar began to weaken. So we're actually somewhat bearish on the dollar here, longer term. I mean, I think any views now, you're supposed to have less risk on or wide stops, because we're getting such significant moves that, tomorrow the dollar could be up again. But over time, we do think that the dollar is likely to be headed lower just because we're in this for the longer haul and we don't see this V-shaped recovery. So then it's harder to make that case for higher rates or higher returns in the U.S.